Hello everyone and welcome to Fun with Fitzy. Today's video is Chapter 4, Video 5. We're going to be looking at the classified balance sheet and the current ratio, which we looked at quickly in grade 11. So this again is all review. Financial statements become more useful when the elements are classified into significant subgroups. And so therefore a classified balance sheet classifies these accounts into significant subgroups, and we call them classifications. So basically, we have current assets and current liabilities. But we also have long-term investments. This is when your company invests in other things, like maybe you are buying some real estate or stocks or bonds as an investment. That's where these would go. And also you might have long-term liabilities like your mortgage. You guys know that already. Then there's capital assets. Capital assets are also known as fixed assets or property, plant, and equipment. So you can call them capital assets, fixed assets, property, plant, and equipment as you wish. They all are very interchangeable. And then, of course, we have owner's equity or partner's equity or shareholder's equity, which we're going to spend a lot more time in this course talking about. But for now, we're very familiar with owner's equity. And then current assets, then, let's talk about them first. Current assets are cash or other resources that are reasonably expected to be realized in cash, that's converted into cash, or sold or consumed in the business within 1 year of the balance sheet date or the company's operating cycle, whichever is longer. Of course, current assets are listed in order of liquidity. Examples are cash, temporary investments, things like GICs, accounts receivable, inventory, and prepaid. That's like your prepaid rent, your prepaid insurance. They're sometimes known as prepaid expenses, so don't get those confused with expenses. Prepaid expenses are actually current assets. Long-term investments we talked about, these are resources that can be realized in cash, that means converted into cash, but the conversion into cash is not expected within 1 year, or the operating cycle, whichever is longer. It's going to be over a year. Examples include investment in shares or bonds of another company, or investment in land held for resale. That's real estate. We talked about that a second ago. And of course, capital assets, which I also said could be called property, plant, and equipment, or fixed assets. These are tangible resources that are relatively permanent, and they're used in the business, and they're not intended for sale. They're not there to make you revenue. And capital assets can be further classified then into natural resources and property, plant, and equipment. And we're going to talk about the amortization of these. Now, property, plant, and equipment include land, buildings, and machinery, and natural resources include things like tracts of timber, that's forests, oil and gas reserves, mineral deposits. We're talking about mining companies would use natural resources. And then, of course, there are intangible assets, and we'll spend a little bit of time in Chapter 10 talking about these. And they're non-current resources that do not have physical substance. You can't touch them. They're not tangible. Here we have examples: patents, copyrights, trademarks, trade names. Current liabilities are debts that are reasonably expected to be paid from existing current assets or through the creation of other current liabilities within 1 year or the operating cycle, whichever is longer. That's very long. Basically, current liabilities are expected to be paid within a year. That's how I remember it. Expected to be paid within 1 year. Okay, to be paid within 1 year. Now let's talk about that. So from current assets, so cash is a current asset, you're going to pay your debts, or accounts receivable, as you collect them, they turn to cash, and you can pay off your debts with that. Doesn't make sense though. You could create one current liability to pay off another one. Not a good trend to start. Some people get into this by paying off credit cards with other credit cards and things like that. Not good, but sometimes happens. Also, examples of current liabilities are accounts payable. Unearned revenue, remember, this is a liability because you owe them the service. Okay, so we treat it as a liability until you've done the service for them. Interest payable is another one on notes, and current maturities of long-term debt. So this would be like the portion of your mortgage that is due this year. Long-term liabilities are obligations to be paid after 1 year. So current liabilities were within 1 year, and these are after 1 year. Examples include long-term notes payable, so over a year long, bonds payable, mortgage payable, things like that. Okay, and equity. So the content of the equity section varies within the form. So if it's a sole proprietorship, then there's a single owner's name. So Fitzy, capital. You've seen this all along. Nothing new here. And in a partnership, there would be a separate capital account and a drawings account for each partner. So if I was partners with Sharma and Pluis, it would be Fitzy Capital, Sharma Capital, Pluis Capital, and we'd each have a drawings account as well. We'll talk about partnerships in Chapter 13, my favorite. And a corporation owner's equity is called shareholders' equity, and it consists of two accounts, share capital and retained earnings. And we're going to see that in Chapter 14 and 15 when we get to that, and we will get to that. Okay, so instead of capital and drawings, there's contributed capital, it's sometimes called, and retained earnings. Okay, let's look at a classified balance sheet in report form. So a classified balance sheet is a balance sheet that has the different classifications. Here, remember, this is not a debit and a credit column. We move things over when we want a subtotal. This is a very, very simple classified balance sheet because we, as you know, we have things like HST, recoverable, and payable. That's not even on here. And there's a whole bunch of capital equipment that needs to be amortized. So this is very basic, but basically we have our current assets listed first, then our fixed assets with their corresponding amortization accounts. And when you subtract the two, you get the net book value of the asset. And then notes payable, of course, with the HST recoverable and payable, you have to move them over to subtotal them to get whether or not it's a government remittance or refund on that HST. But anyways, just a rudimentary version of this classified balance sheet. And long-term liabilities would be here. If you had long-term assets, like those investments in stocks and bonds and stuff like that, it would go between these two sections, current assets and capital assets. And of course, your owner's equity here is just the updated capital, because if you've completed a statement of owner's equity, you would get this account. But remember, a classified balance sheet has the different classifications. I expect all your balance sheets to be classified in this course. Liquidity, as a reminder, this was a grade 11 term. It measures the ability to pay short-term obligations when they come due. So the order of liquidity is how quickly you can convert it to cash. And working capital, this is a measure. We're going to start looking at different ratios in this course, and on the final summative, you will have to be doing a analysis of a financial report. Companies have financial reports that have all of their financial statements and notes to these financial statements, and you will be calculating some ratios. And this is the first one. So I want you to keep a separate section of all your ratios because it'll come in handy one day to help you. So working capital is one important measure of liquidity. Basically, the formula for working capital is current assets minus current liabilities. Very easy. If it's a positive number, that's good. That means your assets are larger than your liabilities. And a second ratio that goes along hand in hand with working capital, sometimes called the working capital ratio, we call it the current ratio, and it's a widely used measure for evaluating companies' liquidity, just like working capital, and their short-term debt paying ability. And basically, it's calculated by dividing current assets by current liabilities. So current assets divided by current liabilities. If this number is greater than 1, that means you have more assets than liabilities and you could pay off, generally speaking. So the higher this number gets, the better. And different industries have different standards for these ratios. So I can't tell you what a good number is offhand, but generally speaking, the higher, the better. So let me give you an example. If you did this calculation and you came up with a number of $2, that means for every dollar in liabilities, you have $2 in assets, which is pretty good. So if you were to sell all your assets and pay off your liabilities, you would still have half your money left. So by now you should be able to name all of the classifications on the balance sheet and understand what they are. You should be able to prepare a classified balance sheet. and understand the current ratio. Thanks for watching.